Welcome to the November Market Update. I'm Gordon Toy and we're joined once again by Bill Keenan, General Manager of Direct Equities Research, to bring us the latest market developments. Bill, obviously the US presidential election has been the defining event of the month and has probably beaten Brexit as the defining event of the year. What's been the immediate market reaction?
Yes, Gordon, I think the last couple of weeks have been quite tumultuous. It looks like the outlook's been turned on its head just in the last couple of weeks. So I think we look at it firstly from the policy point of view. I think the markets are expecting fiscal spending to increase, so income tax cuts and infrastructure spending to be increased, lighter regulation generally, particularly of the banks, reversal of globalisation trends that we've seen in the last decade or so, perhaps reversal of offshoring and tightening of immigration, pro-fossil fuels, so a bit of a slap in the face there to the climate change, and lastly we're seeing an uncertain role for US security. Will it withdraw from NATO and Asia? So there's a lot of uncertainty there with policy. In terms of the market reaction, the market's sort of expecting reversal of that deflation trend that we've been seeing over the last 5 to 10 years, and suddenly there could be a pro-growth, pro-inflation policies.
So we could see prices going up.
Yes, so there's an expectation that inflation could make a comeback, and as a result we've seen higher bond yields. They've been rising pretty much every day since the election. Higher US dollar generally is the expectation that money might come back into the US, and higher risk premium generally because of the uncertain role of the US security forces now.
And so what does all this mean for individual investment portfolios?
Well, drilling down to portfolios, there's a lot of uncertainty between the rhetoric and what is reality, what will actually get through the Congress. But at this stage, rising interest rates, steeper yield curve looks bad for bonds at this stage. And interest rate sensitive sectors as a result, utilities, infrastructure, REITs are being beat up by this higher bond yields. On the opposite side, we're seeing banks and resources rally. So as I've said, it's been a real 180-degree turn in the outlook just in the last couple of weeks.
And in commodities, we're seeing some mixed moves as well, metals going up and then gold and oil selling off.
Commodities are actually pretty confusing at the moment. We're seeing actually a very mixed movements. We're seeing iron ore and coal power on to higher levels, whereas oil has actually fallen, probably because of the pro-fossil approach. Fossil fuels might mean more oil supply out of the US. So oil's actually retreated and gold's retreated, which I suspect is to do with the rise in the US dollar. So we've seen reversal of trends in the last couple of weeks.
And what can we expect then for the rest of 2016? Is the Fed still on track for a December rate hike?
Yeah, this pro-inflation sort of stance of policies that people expect now seems to have increased the odds of a Fed rate hike to over 90% now at the December meeting. So it looks like the yield curve is definitely rising and steepening as we speak. The next thing that coming up is interesting is, will this populism trend that we see continue with the Italian constitutional reform election vote coming up December 4th? There could be a movement there to force out the Prime Minister and force elections, so that's the next major event for Europe. And then following up in the next year will be the French general election, and will this trend of movement to populism continue? So there's a lot of uncertainty at the moment around Europe and the US in terms of policy.
Well, it sounds like there's still plenty of uncertainty even through to the end of the year. Thanks for joining us, Bill, and to our viewers, thanks for tuning in. You can catch Bill Keenan again next month, but in the meantime, for better investment outcomes, visit lonsec.com.au.